Hello and welcome back. This is David from the Personal Finance Squad. In this video, we're going to go through your W-4 form. This is where you determine by filling out your worksheet how much money you're going to pay to the federal government during the year. And what the IRS will do is determine if you paid in too much, which means you will get a return, or if you did not pay in enough, you will owe them. Now we have a sample paycheck here in front of us that we've used in another video, and we're going to use it again here. And we see that the federal tax in this case out of this check right here is $239.23. So we can see that the $3,077 is the number that is used because there is $100 going into pre-tax money, and that was for a 401k. So 7.77 is a way of letting you know where you're going to be in terms of percentage. And then certainly by dollar amount is what we're going to figure out as we go through this video. Now you can see right here, this is what we're getting into by dollars, okay? And we see that you have rates here. You would also hear it as your tax bracket. What tax bracket am I in based on these particular categories? So you can see single filers, and this is what Jasper was in the book. This is what we're going to consider you as an individual just for purposes of this video. And then there's married joint, which means you got two people. And there's just the head of household, whoever that person is. So we can look here and say that we know that the number we've been using from the book was $80,000 as a salary. And that would put you or Jasper at 25% as the tax bracket. So now you're in this range, and then you need to determine, am I putting enough tax in? So now we see we get into the withholding down here. And the best way to do this in terms of not having a CPA or not knowing exactly because you might have a tax software that can't quite tell you these things, you just need to understand every year to take a quick peek and see what works for me. So what we have here is an IRS withholding calculator, and this is a great way to get a gauge of what you're doing. Now again, your CPA can tell you this if you have one, because they can do future schedules based on income and deductions. But again, for purposes of this video, you have the option to use this calculator to give you a good gauge of what you need to do. So we brought it up here already, and again, we're going to base this on a single return. And you can see right here that single has been checked. And then you see this here, can someone claim you as a dependent? And that would mean me being, let's say I was 7 years old and my mom used me, I'm the dependent. Or if there's 3 kids in the household, there'd be 3 dependents. Now in this case, like we use in the book, for example, Jasper has a child, but that child can't be claimed here. This is just saying no one can claim me as a dependent. Therefore, the answer is no. So we continue, and then there's a series of other questions in here. First one is, how many jobs will you have during the year? And we're going to say 1. Now, if you have had 2 jobs, then you would obviously put 2 or 3. Some of you will. And then you can see these other questions. You can check as many that apply to you. So again, based off the book and the path we're going at, we're going to choose this one right here that says, check the box if you contributed to a tax-deferred retirement plan. And since there's a 401k, that answer is yes. Now a cafeteria or a pre-tax plan could be many of these other things in here. You can see one of them, health savings account, flexible spending arrangements. Now in the book, in the exercises, there's a flexible spending account, right? Now, check box if there's a scholarship or fellowship grant this year, included in the gross income, so that means somebody gave you money and you have to include it. So in this case, we're going to say no. We also see that you're not going to be 65, so we're going to skip down there, and then we're going to say down here, we see child and dependent care credit. The general rule is that you're going to have to look into this based on your situation, but if you're in the 15% tax bracket or higher, it's probably better off that you use the dependent care from your account, meaning your DCAP, your dependent care assistance plan, to take that money out pre-tax out of your check rather than taking the credit here. So the conventional theory is that you'll just end up with more deductions, the ability to have more money in your pocket. The idea is you want to pay less in tax. So when you take pre-tax money from the DCAP, again, that's lowering the amount of money that you have to owe into tax. Okay, child tax credit. And you can see here that there's some conditions that you may be entitled to tax credit for each year of your qualifying children. A qualifying child is your son or daughter, adopted child, grandchild, stepchild, and foster child who is under the age of 17, and a United States citizen or claimed as a dependent on your tax return. So if you have a dependent, you could probably put 1 here. In this case, we're just going to leave this as 0. We're just playing around with the numbers here. And then you have other tax credits right here, and you can see there's a number of other conditions. For example, if you adopted a child, this may apply to you, right? Maybe there's some educational credits that you get a little extra money for, depending on your income and your situation. So again, for this purpose, we're just going to continue. And then you can see in here that there's some information that they're asking. So on the paycheck, we said that the gross pay for the year is going to be $80,000. So we're going to put that in there. And then total contribution to tax deferred plan. So this is what you're going to put away. In this case, there's a 401k, right? And there was $100 per check, and there's 26 checks a year. So we're going to put $2,600. Cafeteria pre-tax plan, you can see there's flexible spending account, for example, right? Health savings accounts. We saw some of these in another screen. So again, you're going to have to read through these and see what applies to you. We could say, for example, let's just throw in that there was $1,000 for a flexible spending account. Now we say enter the total federal tax withheld to date in the 2016. And what you have to know here is that when you fill out this calculator here, it's based on the time of the year that you're doing this. And as of right now, this is at the 28th of August, as you can see down here. So you're going to have to project out how much tax you've paid in at this point. So on the paycheck and the video that we've looked at in the Word file, it's just based off the first month of the year. At this point, based on the 2016 calendar, there's been 17 pay periods. So we've already went ahead and projected how much tax has been paid in, and that's this number right here. And then federal income tax withheld from your last salary. So that's the $239. And then how frequently you're paid. So we're going to say this is biweekly. And select the date closest to when you first held this job. So we're just saying here that you started in the beginning of January. You've already had the job. It could just be a carryover from the last year. And then December 31st. So you're just saying here that I'm going to be working for this entire tax year. Other taxable income. You can see that tips. We talked about bartenders, wait staff, things like that. People who have seasonal work that might get tipped. Maybe you're somebody who works as a stylist and gets tipped, things like that. This is what they're asking for here. It could be somebody who gets paid cash for being on a model shoot. Things, whatever that may be, these are the things that you need to put in here. Now, truth be told, most people who make tips of some sort or another, and it's not tracked because you really can't when it's cash, will often fudge this. I'm not saying to do that. I'm just telling you what reality is. And there's a reason that people do that, and that's just for the simple fact that it's not tracked. Unemployment. Did you receive unemployment? So we're going to say no to all of these questions in here. It has an estimate of any other non-wage income. So dividends, interest, or alimony. Alimony is money that's given to you in this case if you were divorced, given by your ex-spouse. Dividends and interest off your investments. Now, if you reinvest dividends and interest, by the way, you don't have to list it here because that means the money's not actually been taken as a distribution. And we're going to say 0. So all 3 of these were good. And then enter an estimate of your 2016 adjustments to income, including alimony paid. So this would be alimony that you paid out to somebody if you're divorced, or deductible IRA contributions and educational loan interest. So that would be interest that you've paid to the government for your student loan. IRA contributions that's money that you put in your retirement, and that's deductible because you've put money in there for your retirement. So we're going to continue with that. Okay, deductions. You can see we have itemized deductions. Does this apply? Are you married and filing separate? And the answer is no. Are you filing a tax return for a short tax year because of a change in an accounting period? And that's no. And then you're a non-resident or dual status alien during the year. So that means you're in 2 places, or you are an alien, which means you're not a citizen. Okay, so in this case, the answer is no. It's a single person, and we're going to leave that one aside. You can see medical and dental expenses. They're saying here that if you go over 7.5% of your dental and medical expenses up to what your AGI, which is your adjusted gross income, is, then you can start getting deductions back. And again, that means you'll be paying less tax. So that means if you have an AGI of $100,000, that means you'd have to have over $7,500 to start getting deductions. So that would be, for example, quite a bit in bills, right? Now some people actually, they run into this situation, so this is a benefit for them. Taxes you paid and interest. Taxes and interest are based on if you own a home. So taxes from the city and the county or whatever they are derived from for you can be deducted. Now interest would be coming from a mortgage if you have one. Then you see gifts to charity, casualty, and theft losses. Hopefully nothing bad has happened, but if it does, this might give you a little bit of a break. And then you have job expenses and most other miscellaneous deductions. This is very similar to the medical at 7.5%. What they're saying here is that 2%, if you cross 2% of your AGI in unreimbursed expenses from your job. So that means, for example, if you go to a job and you bring your own computer, you can deduct that. If you have to buy your own uniform, you can deduct that. If you go to one location to drive to work and then you have to drive to another location that's outside from that in a given day, you need to track those miles because those miles can be deducted. Now again, you have to add up all of these things that apply to this, and then if you cross the 2% threshold, then you can start getting some deductions back, and meaning you're going to have to pay less in, which can help your return out, or reduce the amount that you may owe depending on how much tax that you've paid in. So this doesn't mean that you can go buy just jeans and socks and shoes and a tie and write that off. It all is dependent if it's something that your work should supply but does not. And again, if you need to know further on that, you can look deeper and to see what that is. We'll probably have a video on it, or certainly talk to whoever it is that handles your taxes. Even with tax software, they should give you a pretty good gauge of what it is that you can put under this category. And there's other miscellaneous items. So we're going to just leave these for 0 at this time just to get through the exercise here. And then this is pretty nice. What they tell you here is based on what your responses are and your anticipated income, they want to know how much tax that you're going to have to pay. This is letting you know what you need to do. So you can see that it says right here that the anticipated income tax, saying this is what you need to put in, is $12,290 for the tax year. Then it says you're going to have a projection of almost $6,000 being withheld, but that means taking $12,290 from $5,975 leaves $6,315 being short. That means you're going to need to put in more than what you're doing at this pace in order not to owe the government money. So then they say one thing you can do is change your withholding to 0. And 0 is the only way to have the most money taken out of your paycheck, the most withholding by the federal government only. But you can also opt on your W-4 to say I want an additional amount out of my check. So they're saying, hey, they're going to perform their calculation, so you file 0, but you're still going to be short another $38.24, and then you can take that money and divide it out to determine how much money it is to make it up. So right off the bat, they tell you 0 on your line 5 from your W-4 to how to make sure that you get this 0 to get more tax out or more withholding. And then this $38.24, they're saying by the number of paydays remaining in 2016, right there, line 6 from your W-4, this extra amount you need to have withheld is $478. So they're saying, listen, you have 9 more checks to go. And then you multiply that by 478 plus the 0 here, and you're filing, and you will meet this $12,290. And then also, of course, you need to check single on the box. So if you already filled out a W-4, you're going to have to go back out and fill a new one out to make sure that it's set up properly for the time going forward. Okay, so this is pretty much it here. They run through and tell you all the things that you filled out, so if you want to go back and start over, you can. This is just, again, a tool that provides you information how to gauge what it is you need to pay in. And again, there's deductions of all sorts and shapes and sizes that you need to keep track of, or your CPA or your H&R Block person would do, whoever this may be. Some service can tell you this, but it's your job to make sure you keep an eye on it, because even they can't tell you exactly, but they can put you pretty close in the ballpark. Every tax year changes, and so therefore you need to make sure that you keep an eye on it. No different than handling your budget on a monthly basis, yet planning it for a year. Okay, so that's going to conclude this chapter, and we will see you in the next video, and we will certainly get into some more pieces of information to help you understanding your paycheck and your withholdings and ways to, again, put more money in your pocket and not someone else's. So we thank you for joining, and we will see you in the next video.